Hi friends, welcome to our YouTube channel. In this video, we'll be seeing the basics of stock market. So basically, we are going to look into what is a stock market, how a stock market works, what are the risks in stock market, and how to invest in stock market. So basically, a stock market is a platform for investors to buy and sell public listed companies. So public listed companies are nothing but a company which, in order to meet some capital needs, plans to sell their a part of their shares in the stock exchange, so that investors can buy and sell the stocks from that particular company. So here the company might be going public in order to meet capital needs, such as they might be planning to expand their business in some other location, or maybe they might be planning for some other business expansions. And in case they might also be looking forward to repay some of their loans, existing loans, etc. So these can be any reasons where a company might wanted to go public, and they might be listing some of their shares. Say if the 100% promoter holding, they might be listing 5% or 10% or 15% of shares in the stock exchange. So in India, we have namely National Stock Exchange and Bombay Stock Exchange as the two stock exchanges, where National Stock Exchange is the largest stock exchange in India. So in a stock market, we have various stock stakeholders, namely companies, investors, brokers, and regulators. So as I say, these companies are nothing but the companies which wanted to raise some capitals, and they wanted to go public to meet these capital needs. So investors are people who wish to buy and sell these shares of these publicly listed companies. So the investors can be either investors who are investing for their future, and then full-time traders who trade fully in the stock markets to meet some monthly needs. And then we have the institutional buyers or institutional investors who buy in. I mean, these are large institutions. Say in case, say like we have the PFs amount, right? So we have various employees. I mean, every employee might be a PF amount might be deducted in his salary, and this might be going to the public. Whereas the government might be taking these, making use of these PF amounts via the LIC and notably these companies, and they might be investing these shares into the stock market in some of the fundamentally strong companies, and they might be multiplying their money, I mean the PF money, to meet the future needs, and then they will be returning it at the age of 60, or whenever the PF amount is demanded by these individual employees, I mean in the Indian constitution. So other than this, there can be institutional buyers. I mean, institutional investors can be domestic institutional investors, and they can also be foreign institutional investors. Mostly these um, institutional investors mostly contribute much towards stock market. And then we have the brokers. So the brokers are the intermediary in between the stock exchange and the investors. So where the investors buy and sell shares of companies through the stock exchanges. So brokers generally they do provide mobile applications, and then they also provide web interfaces. And some brokers provide, I mean, some brokers also offer these algorithmic trading, so where some predefined configuration rules and technical analysis factors, and I mean indicators, can be made use to meet these conditions to place automatic orders, etc. So when we have the regulators, I mean in we see the other stakeholders, companies, investors, brokers, etc. So there must be some rules defined to these individual stakeholders, so that they are within the guidelines of this, I mean, regulations. Say a company, we are not sure, some company might be getting listed in the stock market. We are not sure how well or loyal that company is. Some people might be going and investing, and it can be entirely big scam as well. So what these regulators do is regulators, they just monitor all the stakeholders. They define some well-defined rules, and they ensure that all the stakeholders are within their rules. And if any breach something happens, they take appropriate legal actions against these particular stakeholders. So in India, we have the SEBI, Securities and Exchange Board of India, which does these regulator work. So and then we'll be checking on what is, I mean, how the stock market works. So basically, I mean, we have the IPO. I mean, we have two markets, a primary and secondary market. So say like the primary market is a platform where the stock appears first time for buying. In the sense, when a company decides to go public, it might be, let us check this initial public offering process. So a company might be needing some capital. It plans to raise a capital by making by deciding to go public in stock market. So what it does is it applies with SEBI to get listed in the stock market, and then it announces as IPO. IPO is nothing but initial public offering, where the stock is getting first time listed in the share market. So this company gets the help of the bank to identify the share prices and the number of shares, and by estimating the market capital and the assets cost, etc., everything. And then they get some approximate number of shares that they wanted to go public in order to raise that capital, and then they apply with the SEBI, which then I mean checks that rules of that particular company. I mean, if that company meets the rules, and if it approves the company, announces its IPO. So once then the company does some marketing to attract some investors to buy this initial public offering, and then I mean people start to bid. So this bidding duration might be initially 3 days, and in some case if the bid is very huge and many number of people are bidding on this, the bid duration might be increased. So what will be done once the bidding period is closed, the company might be analyzing the bids, and then say like if the bidding happens between 550 and 750, the company might be picking up the highest bids to equalize the number of shares, and then it allots the shares to the respective people. If some people have bidded for that IPO and they didn't meet the bid criteria, I mean say like selection criteria, they might be refunded. So with this, the final bid price of the company gets listed, that the company gets listed in the National Stock Exchange with the final bidding price. So this is the process of initial public offering, where a company wants to go public, and then they get listed initially in the initial public offering. They list their shares in the initial public offering, and then the public buys. So after that, they get listed in the stock market. So other than this initial public offering in the primary market, we have the follow-on public offering, where a company has already done the IPO and the company shares are being traded in the stock market, and then the company is in need of some other additional capital, and they wanted to raise some capital once again from the public, say like 100% of the share initially they had, and already they have sold 5% of the shares via the initial public offering, and they wanted to meet some more capital needs, and they wanted to list again 5% of shares in the stock market. So again they are reducing their promoter shareholding from 95% to 90%, and this would be known as, again they would be listing in the primary market with the FPO with the number of shares. So this is known as a follow-on public offering. So right to share is something like the company decides to sell some shares to some people, I mean the investors at a discounted price. So these would be coming under the right to share. So all these three actions, the initial public offering, follow-on public offering, and right to share, will fall under the primary market. So as I said, once this IPO process is done and the stock is starting to get traded in the secondary market, as also this is place where investors interact via mainly via the stockbrokers on a daily basis, or so to buy and sell stocks of that particular company. So the stock price in the stock market is being decided by the supply and demand. Say a supply is a place where there are many buyers, and the demand is a place where there are many sellers. So in the case when there are many buyers, the price might be going high, and when there are many sellers, the price might be going down. So this is how the stock price is getting traded in stock market, mainly because of supply and demand. So other than the supply and demand, we have other factors that is affecting the stock price, namely company performance. The company performance may be company audit reports in the case of quarterly profit, annual profit, consequent performance of quarterly profits or annual profits. And then we have other factors such as company management decisions, etc. These all factors might be contributing towards the company performance, and based upon this company performance, it might lead to the it might be attracting some users, and it might be attracting some, distracting some users. So due to this, the stock price might get altered. So other than this, we have the market sentiment. So sentiment is something, but the entire market might be in the bullish zone or bearish. Bullish view or the bearish view. So this might also might be contributing towards the stock price. And then we have the economic indicators, namely inflation, recession, GDP, and we have the interest rates. So these might also be directly affecting or impacting the stock price of a company. And then we have the trading volume. So the more the good the volume is, or high the volume is, the more the stock is going to move high. So this is basically, more buyers and similar to more buyers and more sellers. And then we have the industry trends. So at some time period or some year, some industries might be performing good. So in case of during the COVID phase, after the COVID phase, the pharma sectors were performing good. So the pharma stocks might be picking up high. So the particular industry of the company also decides how the price is going to move on. And then we have the political events. So say like when a government is formed, how the government it is. Say it is a minority government, or the government has some majority strength, or the government is offering some good industrialization views and have some policies to develop industrialization and the economy. So in these cases, automatically the stock market will be going high. In the case of any, say like if the government is not very strong, and if the government is very, it is a minority government, automatically FIIs might be a little bit hesitant to invest in that particular national market. So these are the various factors, those that are affecting the stock price. So and then we have the types of trading. Say like different people invest with the different views. Say some might be investing with a view to with the long-term investments into the Indian stock market. Um, Long-term view in the sense that they might be wishing to save some amount towards their future after the retirement. Say in that case, they might be having a saving some money. Say not only into the stock market, the people used to invest in many fields. They used to invest in gold. They used to invest in real estate. The lands. Some people used to invest in houses, etc. These kind of investments. Some people might be interested in stock market, and they might be coming up and investing in stock market for their long-term future. So based upon that, we have the categories of types of trading. Some traders might be entering and exiting on the same day. So those traders are called intraday traders. So the view of this particular intraday traders is to make some short amount of make some profit within the same day. So whereas we have the delivery trading, say like these people, what they used to do now, they used to buy and hold the stocks for more than a day. Delivery trading is nothing but if they hold the stock for more than one day, it is known as the delivery trading. And then we have the futures trading, futures trading. Of that, we have futures of underlying stocks where the future has some expiry day, and based upon that particular future, they have some lot size as well. Based upon this lot size and these futures, people used to buy futures, and then they used to make some good profit with futures trading. And then we have the options trading. Options tradings are also derived from the underlying stocks where they have some strike prices. Say in case of bank nifty, we have 40, 140, 240, 300, etc. So these are the respective strike prices, and they have some options have some premium value. And typically there are two types of options: one is call option and put option. So in both options we have buying and selling. So in case of buying, the option, say like option call option would be with the view of bullish. In the case of option put options buying, the market view, people would go with the intention of bearish view into the put option buying. So based upon this, premium values are contributed based upon the strike price, current price, and then kind of like intrinsic value, extrinsic value, time value, etc. So based upon these factors, the premium value is calculated. So this is basically about option trading. I will explain it in a detailed video and some other videos about option and future trading, and kind of like swing trading. Swing trading is nothing but when a trader he usually buys to buy a stock and then he holds for a couple of weeks to a couple of months or a number of months. It is usually known as swing trading. So these people they try to make use of short momentums and they used to grab those profits. And then we have the position trading, which is nothing but they have the view of long-term investments based. Basically, they buy and hold the stocks for months to years. So they have the view of a long-time investing and to make some money out of it. For their they might be investing their money for their future, etc. So this type of trading is known as position trading. So we have the types of traders as well. So basically, I mean the people who do intraday trading are known as day traders, and swing traders are the who does swing trading are known as swing traders. And then we have the positional traders who do positional trading, as explained in the previous slide. We have scalpers. So scalpers are nothing but who does scalping. So scalping is the process in which people intentionally go with making some short movements. Say if they might be some might be grabbing the movement when some 10 points is moved. So they might be increasing the quantity size, a lot size to grab the small movements of 10 points and they use to make big profits. So and then we have algo traders. So algo traders generally make use of some algo platforms, algorithm platforms, or some kind of like might be making use of some technical indicators and some other combinations to make use of some three different conditions to create these algorithmic rules. And then we have the institutional traders. So institutional traders I have already explained, where these institutional traders are some large institutions which make use of the I mean public money or some other I mean their institutions money to invest in stock market and to gain and to make some huge profits out of it. So other than that, we have the retail traders who have, I mean, retail traders are nothing but people like us who do the trading based upon, I mean, like to make some short profits or long-term investments, etc. So basically, I mean, this is an example of intraday trading. Here we have the HDFC Bank chart. So in this HDFC Bank chart, this is a 15-minute time frame chart. So in this, you could able to see that this is the date 13th, April 13th. So let us make a position. I mean, if we are trading out of the resistance and support zones, let us assume that I'm making a trade at buying the HDFC Bank share at 1680 at April 13, 11:30 a.m. Then I'm selling it at 1695 at April 12, 3:20 p.m. So I could short period I mean within a day I could make use of I mean make a profit of 15 rupees per single quantity. Say a person is having a capital of 1 lakh, he can able to buy 59 quantity of HDFC Bank shares at that 1 lakh capital. So probably you would be making an profit of around 85 rupees where the ROA is around 0.88 percentage. So say like all the trades should be done with stop loss. And say if I had made a stop loss of rupees 10, my max loss would be 10 rupees per quantity. And for making for this 59 quantities, I could have been made a loss of maximum loss of 590 rupees. So my profit and loss would be varying between 885 rupees to minus 590 rupees for this intraday trade. I mean, this is an example. You can just pick up some other stocks and you can just make sure to do some analysis on this. So this is an example of delivery trading. So I mean, generally delivery trading is holding a stock for more than a day. Say like I'm going to buy a stock at around 1560 of HDFC Bank on March 23 and I'm going to sell it at 1680 on April 12. So basically what I'm making a profit here is for one quantity I'm getting 120 rupees profit. So a person 1 lakh and 1 lakh of capital can buy around 64 quantities where you can make a profit of around 7,680 rupees and this return on investment would be around 7.68 percentage. So this profit is gained within a period of 20 days, right? So that is good. If we had set a stop loss of around rupees 25 rupees, his max loss could have been 25 pair quantity, and maximum he would have lost around 1600 rupees. So his loss to profit ratio would be around 1600 to 7680. So this is a future chart of HDFC Bank. So April, this is a future contract chart of April month. So the same concept I'm applying here too. I'm doing buying activity at 1560 rupees on March 23 and selling it at 1690 on April 12. So one lot of HDFC Bank future is around 550 quantity. I mean, these futures and options have the lot size. Say like HDFC Bank has a lot size of for one lot it will be 550 quantity. In case of Bank Nifty, we have one lot is 25 quantity, and Fin Nifty it is 40 quantity per lot, and for Nifty 50 I have 50 quantity per lot. So a person has to buy one lot only. He cannot able to purchase more than, I mean, less than 550 or in multiples of 550 only would be able to buy. So say like for buying a future contract, he has to maintain some margin. So this margin calculation I will be explaining it a separate video. In this video, let me say that for buying this 1690 rupees, I mean March 23 for buying this April future, I will be requiring 1.7 lakh to buy 1 lakh. So for profit for 1 lot would be around 71,500 rupees. Say like we are nearly gaining 130 rupees per quantity, and for 550 quantity it would be around 71,500, and my return on investment is around 42%, which is very huge compared to the regular trading or I mean the day trading or swing trading in the case of future. So suppose say if he has set a stop loss of 25, if that stop loss 25 estimate, he could have faced a loss of around 30,750 per lot. Here the loss is also high, the gain is also high. So you have to notice about it. So this is the future option chart. So say like on April 3rd, sorry, this is April 3rd. On April 3rd, I have decided to go with, I'm assuming that based upon the fundamental analysis and technical analysis, I'm assuming HDFC Bank would be reaching 1600. So in that case, what I'm doing is I'm planning to buy the HDFC Bank April 1600 CE at rupees 38 rupees on April 3rd. So this is you can this is a error. So you can mention it as, I mean, you can consider as April 3, and I'm going to sell it at 90 rupees on April 12. So for per lot, I'm going to make a profit of around much 52 rupees. So as I said, one lot of HDFC Bank is around 550 quantity. Say like I'm having 1 lakh rupees capital, then I could be able to buy 4 lot of this April 1600, which is around 220 quantity. So generally considering, so profit for 1 lot is around 28,600, whereas for a profit for 4 lot is going to be around 1,14,500. So actually here the sum up is, I mean, I'm having 1 lakh capital, it is doubling the price. So this is what the beauty of options. So here the return on investment is around 114.5%, which nothing else can offer this much amount of. So say like on the other case, if you had a loss, say like I'm having setting a stop loss of 25. My max loss could have been 13,750 per lot, and for 4 lot 55,000. So again you have to notice here the gain is also high. Maybe in case of the loss, I mean stop loss, the stop loss could have also been high. So you have to consider risk. The option trading may be shown as portrayed as very high rewarding, but the options has high risk unless you understand or clearly predict everything, or I mean clearly analyze the fundamental and technicals of a chart, and you don't trade, you are going to be on the loss side. So please be careful with the options. So as well, options have this time expiry values, and say like if something monthly sideways candle is maintained for a stock or something like that, you are going to be on the loss side, but the premium decay itself will be eating our profit, I mean the capital. So this is an example of swing trading. So I'm swing trading, and I mean earlier I have mentioned about the delivery trading. So you could assume the same example here of HDFC bank stock. So I'm going to hold the stock for a period of 20 days, around nearly 20 days. I'm buying at 1,560 and 1,680. So you can refer to that example. I mean, you could make a profit of 7,680, and then a maximum loss could have been 1,600. And this is kind of like position trading, where I have bought a I mean, say like I'm going to buy a share and bought a share in 2014, and I have sold it at 2022. Say like in 2014, March 3, 2014, I have bought the HDFC Bank at rupees 350 rupees. and in 2022 I'm selling it at 1500 rupees. I'm nearly making 1150 rupees per quantity, right, in nearly 8 years. Yeah. So suppose say like I have invested 1 lakh in HDFC Bank in 2014. I have 285 quantities. Check my profit now. No? So right now I have 285 quantities, which is around my current value would have been profit would have been around 3 lakh 27 rupees, 27,750 rupees, and my return on investment is very high compared to others. But this takes a long time, right? It takes around 8 years to reach this point. Around 327.75% is very high. Say like if you had a stop loss of rupees 25 rupees, maximum loss could have been very less, right? So this is the beauty of these long-term investments. A stop loss can be very high. I mean, your losses can be limited. So in the case of investing in some other, you have to be very thorough with the fundamental and technical analysis, and you have to keep monitoring the market as well. And then in case of any say in case of any changes or unwanted twisters in the company we have selected, and some changes happen in the management or financials of the company which we are investing, we have to just check the market, and we have to act accordingly on that period. In the case of swing, this is actually a position trade only. And then definitely stock market, it does provides risk rise to everyone. So we have given to see what are the risks for the short term investors. So market volatility is nothing but fluctuations. Say like stop losses maybe this might be the case of day traders or swing traders. Say like they would have some stop loss points. Based upon each one's capability or capability of loss, they might be setting some point as stop losses, right? So the our fundamentals and technical analysis might be working, and our target point might have reached, but before hitting the target, our stop loss would also be triggered. Say like I'm buying at 1560 and setting my stop loss at 1420, and my target is 1600. Before that, what happens due to some market fluctuations or something like some scenarios in the market, my stop loss 1520 is hit, and again it is bouncing back to 1600. So these kind of market volatility is extremely risky, where some days people might be unwantedly losing their capital. So this is one risk, and then we have the averaging losses. People have a tendency that they might be thinking that the stock might be reversing up at each point. Say in case of I'm buying an option at 450 rupees, say I haven't set any stop losses there, and then the option price has reached around 300. I am of the view that 300 is very less. I have bought at 450. Again, the stock is going to pick up, so I'm going to buy and at another quantity or another lot at this 300. And like this, I might be adding upon a few more contracts to average prices. And finally, what happens is the price would not be reaching our target, and it might be trading in the opposite side, and finally would be losing everything. So it's always good. Don't average it. Don't do the averaging on the losses side. Always do average on the profit side. So and then we have people used to do over trading, right? So greed. So greed only does triggers this over trading mentality of the investors. Say like I am buying and I am making a profit of 5,000 rupees. I have made a profit of 5,000 rupees today. What happened is again I am getting some greed, that overconfidence also I'm getting now. And what I'm doing is I'm going to do some more trades, and again I'm facing up with some stop loss hits, and I'm losing all this 5,000 rupees, and my total day profit has become minus 2,500. So always stick with your trades. Say in the case if you have some profit to be done as 2,000 rupees, stick with 2,000 rupees, and once you get the 2,000 rupees, move out of the day. So as well stop losses too, you have to have the same criteria. I have set define stop losses for your capital. Once it is reached, don't trade on that day, and then move on to the next day and check out. So and then we have the trading without stop losses. No? So say like someone is having a trade, doing a trade at 400, he hasn't set a stop loss. So generally, if you are trading around and if you have a bullish view, what you might be doing is you might be setting a stop loss of 50 points or 24 points, etc., based upon a capability, and you might be waiting for the stock to move up. So in some cases, what might be happening, some unwanted situations or something we might have missed, and what happens, the stock might be going against us, the trade might be going against us. and from 300 400 the price would have been fluctuated to 100 rupees and 150 rupees. Within same day the option might have gone to 250 points down. So what happened is we here loss becomes unlimited. So if you are not setting the stop losses, this is the result. So and then money management, you have to manage your capital well. Say like if you have the 50,000 as capital, don't trade for all this 50,000. Just try to make some amount of try to get some I mean 5% or 10% of returns for a day, and then quit off for a day. If you are trying to overtrade, or if you try to spend your whole capital, 50,000 capital, some losses occur, you would be facing very some technical errors might happen. Sometimes you might not have incorrectly update the stop loss. Sometimes while selling you would not have sold the all the quantities. These kind of errors, we are humans, right? We used to we have the tendency to do errors. So what you do always is proper money management. You properly manage your money so that you don't trade all your capital and have some capital in order to do some recoveries. So in case of long-term investors, say like poor management decisions can be one of the worstest criteria. Say like a company might be 1 year have selected or picked up that stock, the company fundamentals would have been very good, and the company might be results would have been very good. And what happens over the years, some management gets changed, the CEO of the company gets changed and replaced with someone else. He's taking some horrible decisions, and the company again goes on the downer side. So this kind of risk which is not in our control, so we have to we can avoid this kind of risk only by monitoring the markets and these kind of the decision making processes, and in case of any change results etc, and then we have to look over this or take the decision accordingly. So we legal issues, the company might be having any legal breaches or legal issues, so these might be also a risk factor. And then we have the economic factors such as inflation, recession, and interest value. So these factors are we cannot able to do anything with these factors. We just we have to act accordingly at that part, and nothing else we can do. Suppose if we are holding for a long-term investments, we need to know how strong that company is behaving fundamentally in the inflation or recession period, and we need to make the decision accordingly to hold or exit from that position. And then panic selling, sometimes say like inflation might be coming up, the company might be very strong fundamentally and still performing very strong, but say like they might have bought at 30 rupees and the price would have reached at 400 rupees, again it might be falling to 50 rupees. They would got panic mentioning that, so they would be landing upon the lesser profit in this cases. So and then some people used to trade without diversified portfolio. Say like everyone, they used to take all the profit and invest in a single company. What happens over the days, the company might be performing well, but over the decades, or I mean over the years, we cannot sure, right? Within after 10 years, we don't know, right? What might be that situation of the company, how the decision would be. The company, although looks good today, after 10 years, we don't have any idea that the company might be still perform good now. So other case, what we have to do now, we have to split our investments into diversified portfolios into multiple companies. In these multiple companies too, 10 to 15 companies, if you are picking up and you have some strong fundamentals and technicals, then definitely you could have gone with that diversified portfolio scenario. So if you are trading without a diversified portfolios, again, it is going to be a huge risk. So basically, everyone asks how to invest in stock market, right? So to invest in stock market, you need to have or open a trading account with the stockbroker. So there are many stockbrokers, namely Zerodha, Kite, and then we have the Angel, and then we have Dan, and then we have the Allies Blue, and then we have full-time stockbrokers, namely like Kotak Securities, ICCA, HDFC, etc. HDFC Securities. You can pick anyone by comparing their ratings, reviews, and then the brokerage charges which you could afford, etc. And then you can pick one stockbroker, and you can create account with them by providing a PAN card and opening with a demat account by providing your other completing your KYC process, etc. Once you open up your account, you just fund your account, add the money to the account, and then you should do some fundamental and technical analysis, and you need to make sure whether you are going to do a long-term investment, short-term investment, or what you are going to do, and then you pick some stocks and then start investing. So this is basically a screenshot that is took using the Zerodha. So where I'm just searching for the HDFC bank, and then I'm adding it to my watch list. So once I have added to the watch list, I'm doing a buy activity. So once I click on the buy window, it comes pop ups over here. So where we have the market price and limit price. The market price is something like we should be buying at the current price of the market, which is around 1692.45. And in case of a limit, say like I'm expecting that HFC to come down on the day around 1680, and then I'm setting a limit order at 1680, and then I'm making a buy. Yeah, friends, thank you, friends. I hope you all understood this basics of stock market video. If you have any queries or doubts, please let me know in the comment section. So I will try to clarify those. Please do subscribe to this video, and please do like to this video to stay tuned for updates. Thank you all. Bye bye.